Many thanks for joining us. Welcome to Business Incorporated. I am Bisi Adebayo. On today's show, International Labour Organization raises concerns about the devastating effects of COVID-19 on the education and training of young people. South Africa's business confidence recovers from a 35-year low in July. Whilst Ghana expects 5.8% increase in cocoa output in 2020-2021. Well, let's begin the program right away with intraday figures from the major markets we track in Africa, where the all-share index in Nigeria is marginally firming up from yesterday's loss with a 0.09% gain at intraday. It's also a positive sentiment in South Africa as the GSE index is up 0.2% at intraday, while the EGX30 was 0.22% higher as well at that time. Meanwhile, Kenya closed Tuesday's session down 0.75%. And in the Middle East, major stock markets in the Gulf are also up, except the Abu Dhabi index, which is down 0.2%. Dubai's main share index gained 0.8%, while the Qatari index rose 0.31% also at intraday. Saudi Arabia's benchmark index was also in the green at that time, posting a marginal 0.01% gain. Now let's turn to Asia, where Chinese stocks joined the declining trend across the markets on Wednesday as investors continue to monitor coronavirus developments. The Shanghai Composite fell nearly 2%, while the Shenzhen Composite was down 2.69%. The Shenzhen component tumbled nearly 3%. In Hong Kong, the Hang Seng Index dropped 0.21%. In South Korea, the Kospi was down 0.14%, but then Japan's markets bucked the trend. The Nikkei 225 was higher by 0.44%, while the Topix rose 1.16%. And U.S. stock futures rose slightly in overnight trading and pointed to gains at the open on Wednesday after the S&P 500 closed lower for the first time in 8 days. Dow futures were higher by 54 points. The S&P 500 and Nasdaq 100 futures were also in positive territory. And in Europe, stocks edged mostly higher today amid a upbeat start to trading as concerns over a rise in coronavirus cases in parts of Europe and beyond come to the fore. The markets are also digesting the UK's Q2 GDP data. But let's speak with Annette Wiesbach for more. Good afternoon, Annette. How are investors in Europe reacting to the UK's latest GDP data, which showed a 20.4% dive in Q2, and what's the outlook?
Well, actually, at first glance, it really looks horrible when we hear that second quarter GDP has dropped by more than 20% in the UK. With that, actually, it's the worst performing economy in Europe, even worse than Spain and Italy for the second quarter. And there are two reasons for it. The one reason is that the UK is a very service-oriented economy, and like the service sector literally shut down during the whole of the second quarter, and then they were quite late to shutting down their economy, so they were also later to get it reopened again, and that was affecting the second quarter almost entirely. So the good news though is that June was a lot better than people had expected, so with a plus of 8.7% in GDP growth, that was better than expected, and it gives some hope that the recovery in the UK could actually have more or less a V shape, and that is why also the FTSE, for example, rallied on the news. Also, in addition to that, there came support from the Bank of England, who was saying that if need be, there's also room for more stimulus in case the economy is not recovering as robustly as the Bank of England currently is expecting.
All right, now Tesla is splitting its stock. Why are they doing that?
Because it makes it more attractive to a wider range of investors, because currently Tesla is almost trading at $1,500 per share, which makes it non-investable for a smaller retail investor, but also for their employees. And that's why Tesla is splitting its shares into 1/5, so it's a 1/5 share split, going to be effective later on this year. And that's the only reason for Tesla doing that. It doesn't really reflect anything in their valuation. Tesla shares are the most pricey shares on Wall Street, and they're trading at a huge multiple, at 112 multiple or plus their earnings. So it gives you some perspective how much future profit is already priced in the current share price.
Now, let's talk about the New Zealand Central Bank, which has surprised markets by enlarging quantitative easing.
Not very good here.
All right, Annette, we'll get back to you in just a bit, hoping that you will be able to hear us. But let's just see how the markets, that's talking about the crude oil markets, are performing right now. And prices moved higher on Wednesday, and that was after industry reports showed that U.S. inventories of crude fell more than analysts had expected, and that bolstered hopes that fuel demand in the world's biggest economy can weather the coronavirus pandemic. Brent crude was up 0.3% at $44.65 a barrel after falling around 1% on Tuesday, and US WTI was also up 0.2% at $41.70 a barrel, having dropped 0.8% in the previous session. Well, let's find out how investors in the UK are dealing with the gloomy GDP data released today, showing a 20.4% slump in the second quarter. And Juliana Olayinka will be telling us. Good afternoon, Juliana. Of course, this is the biggest story today. We heard from Annette how the markets in Frankfurt are reacting, but let's also hear from you once again. I know you spoke to Chimi about this in the morning, but give us an update on how the markets and investors are still reacting to the gloomy Q2 GDP data at Intraday.
Good afternoon, Bissy. Yes, well, like I said, it appears as if market traders in London had priced in this pretty abysmal fall in GDP, fallen by 20.4%. I believe most economists had predicted it was about 20.5%, so there were no surprises there. The FTSE All-Share has actually increased on those early gains. The All-Share at Intraday is up by 0.76%, the FTSE 100 is up by 0.99%, and the FTSE 250, that domestic market, slightly down by 0.09%. In currencies, the pound is also down on the US dollar by 0.03%, down on the euro by 0.31%, and up on the Japanese yen by 0.27%. As you said, Bissy, it's a major story here. This UK GDP contraction is the worst on record. Some reports are saying it's actually the worst in history, and it does follow a fall of 2.2% in Q1. So technically, Britain is in recession. It's the worst recession that we've seen in G7 nations. I heard you speaking to the analysts there in Frankfurt, and I think the worrying part of the discussion is that we fared much worse than our European counterparts, not just in the fatalities. We have an excess of 50,000 deaths due to COVID, but of course, GDP, I don't want to repeat much of what my colleague was saying in Frankfurt, but it's worth saying because a lot of people are asking, why has Britain done so badly? And there are discussions about just how late we went into lockdown. Prime Minister Boris Johnson didn't ask for a lockdown until the 23rd of March. We were much later coming out. In fact, we haven't come out completely due to local lockdowns and local rises in infection. We have seen that some businesses still remain closed, including nightclubs and some also indoor facilities. So it's a major issue for Prime Minister Boris Johnson. I'm sure he's pretty happy at the moment that we're in a summer holiday recess, so he isn't getting that that scrutiny from the opposition party. But yesterday we also had those UK unemployment figures, didn't we, showing that 730,000 individuals have lost their jobs during the pandemic. That's expected to increase. The Bank of England did say that they expect up to 1 million more people will lose their jobs. Some say that's a conservative estimate. There could be 2 or 3 million job losses in the UK. If you don't have a job, you can't spend your money, which means the hopes for a V-shaped recovery are fading fast.
And talking about jobs now, Juliana, BP is considering a radical reduction of office space in a move to flexible workplace layouts in the wake of the COVID-19 pandemic. Now, what would happen to the almost 50,000 employees who would be affected by this reinvention?
Well, what we're expecting and what we've seen, not just by the oil major, but many large multinational companies, is that they're adopting digital workspaces. They have seen perhaps the productivity of their staff while working at home. They're happy to go forward with using that. So the 50,000 staff that will be affected will either be working from home or will be working from site, but rather than having a desk, you'll be hot desking, which means you will move from space to space. And like I said, this isn't just being seen by BP. We've also heard from Google, we've heard from Lloyd's, we've heard from Facebook, and they're happy to be doing that. This is another problem that British Prime Minister Boris Johnson will have to face, because of course if you don't have people working in offices, you don't have people buying coffee and sandwiches from the local shops, you don't have them buying clothes on their way home. I believe BP have about 70,000 staff across the world. There were talks that perhaps 75% of their property portfolio could be lost. It won't be as much as that, but it certainly could be about half as that. And we have heard from commercial real estate agents in the UK, and they're pretty concerned because, of course, this leaves many empty workspaces. Leases will not be renewed. A lot of these multinational giants will hope that they can sell this space off. But what analysts are seeing is that there is at least a 20% gap at the moment for these office spaces that aren't being filled by staff, and therein lies the problem for the economy, because if they're not out of their homes or their kitchen, their gardens, or in front of their book shelves, then they're not spending money outside.
Now, Sports Direct owner Frasers has delayed annual accounts again for the second time running, insisting that the delay was not due to any problems. Are we really to believe that?
We are to believe that, because that's what they've said on record. But of course, behind the scenes, it obviously shows that there's some sort of chaos going on. I believe their full-year report was due out tomorrow. The announcement that it was going to be delayed was prepared and read out at the stock exchange just after markets closed. And as you said, this is the second time that they've been doing it. The British billionaire, pretty controversial character, some would say, Mike Ashley, has said that they need more time, that of course the pandemic has upended a lot of their accounts and they need to reflect on this. So we believe that it will be delayed by about a week. Market analysts, of course, have been commentating. They've described it as shambolic and chaotic, but we are expecting a statement soon. There was a statement released earlier. I'll quickly, very briefly, Bissy, mention it. The firm said, due to the undoubted scrutiny of our accounts, management and our auditors, RSM, will take this extra week to robustly review the final accounts and ensure that all necessary disclosures have been completed.
All right. Thank you, Juliana.
Thank you.
And gold clawed back some lost ground on Wednesday after sinking 6% in the previous session as equities stalled or dealt over an additional round of U.S. fiscal stimulus and rising China-U.S. tensions. Spot gold was up 0.5% at $1,920.04 an ounce, having suffered its largest one-day drop in more than 7 years on Tuesday due to a bounce in risk appetite and firmer dollar. U.S. gold futures fell 0.7% at $1,930.70 an ounce. Silver was up 1.6% at $25.18 an ounce, and platinum gained 0.5% to $934.52, and palladium was steady at $2,091.59 an ounce. Now we'll talk about Moody's expectations for the Sukuk sovereign market for the rest of the year 2020 when we return in just a moment. Please stay with us. Welcome back. The International Labour Organization has raised concerns about the devastating effect of COVID-19 on the education and training of young people in a report titled Youth and COVID-19 Impacts on Jobs, Education, Rights and Mental Well-being. The ILO mentions that 65% of young people have learned less since the beginning of the pandemic because of the transition from classroom to online and distance learning during the lockdown. The ILO estimates that over 70% of youth who study or combine study with work have been adversely affected by the closing of schools, universities and training centers. The report also calls for urgent, large-scale and targeted policy responses, including the reintegration into the labor market of those who have lost their jobs or who have experienced a reduction in working hours to avoid a serious impact on their mental well-being. Latest data from the South African Chamber of Commerce and Industry shows the country's business confidence recovered from a 35-year low in July, boosted by improving global economic activity. The SACCI monthly business confidence index rose to 82.8 in July from 81.4 in June. The sentiment gauge had crashed to 70.1 in May, and that's its lowest since the inception of the survey in 1985. And below last year's average of 92.6. Meanwhile, South Africa's manufacturing output fell 16.3% year-on-year in June after contracting by 32.4% in May. Data from the Statistics Agency shows that factory production was up 16.8% in June month-on-month, but declined 30.2% in the 3 months to the end of June. And Ghana expects cocoa output of around 900,000 tons in the 2020-2021 season, up 5.8% from the forecast for 2019 and 2020. The country's cocoa board has also announced plans to raise $1.3 billion in syndicated loans to fund cocoa purchases during 2020-21 from a consortium of banks and financial institutions with the government as guarantor. The loan will carry annual interest of 1 month LIBOR plus 1.75%, a commitment fee of 0.62% per year, and an upfront flat fee of 1.25%. Ghana is the second biggest cocoa producer. Its growing season runs from October to September. Now, a recovery in market conditions and an increase in gross borrowing requirements of the world's largest Sukuk sovereign issuers will fuel a rise in nominal Sukuk issuance this year that is greater than Moody's had expected in March. In its latest report, Moody's says while year-on-year sovereign Sukuk issuance volumes remain flat in the first half of 2020, despite a significant increase in government financing requirements due to low oil prices and coronavirus-related spending, issuance will bounce back over the rest of the year 2020 as market conditions normalize. Thaddeus Best, a Moody's analyst and author of this report, joins us now to discuss more about this report. Good afternoon, Thaddeus. Thanks for joining us on the program. Now, let's begin with you telling us what are the key findings of this report.
Good afternoon. Thanks for having me. So I think in terms of the performance of the sovereign Sukuk market, what is interesting is we find that Sukuk issuance volumes, sovereign Sukuk issuance volumes, did not increase significantly in the first half of the year. And that's despite the fact that government borrowing requirements did increase very sharply as a result of the both the drop in oil prices and also the additional coronavirus-related spending that sovereigns have been undertaking recently. So overall, we saw Sukuk issuance at about $32 billion from governments in the first half of 2020, which is roughly the same level as it was in 2019. Now, at the same time, we estimate that the combined fiscal deficit of all of the major Sukuk issuing sovereigns will increase by about $94 billion this year, compared to our earlier estimates prior to the coronavirus outbreak. Now, we think there are several reasons why Sukuk issuance has so far lagged the increase in government borrowing requirements. Firstly, on the demand side, banks in the Gulf, which are a major source of demand for Sukuk instruments, experienced elevated liquidity pressure, both from the coronavirus outbreak and also the decline in oil prices. Secondly, we think the governments may have been concerned about potential crowding out effects on private sector borrowing that a large increase in domestic government Sukuk issuance could have created. And I think indeed for those sovereigns with liquid government assets, like, for example, Saudi Arabia, the spike in borrowing costs between March and April would have very much increased the attractiveness of drawing down liquid assets compared to, say, for example, debt issuance or Sukuk issuance. Now, for sovereigns without sovereign wealth fund assets like Turkey, central bank lending facilities have also been an alternative source of expedient financing for the government. And finally, there's the additional complexity of Sukuk issuance. For example, issuers are required to set up special purpose vehicles to meet borrowing conditions, and in some cases may need to provide physical assets to secure that borrowing. So, these operational requirements can slow down issuance, I think, particularly in contrast to drawdowns from conventional medium-term notes programs, which can usually be executed more swiftly, which is obviously quite critical when dealing with unanticipated sudden increases in government financing requirements like those that have been triggered by the recent crisis. Despite all of this, we do think the Sukuk issuance will bounce back in the second half of the year. We're forecasting a 43% increase in sovereign Sukuk issuance, which will take it to $94 billion for the full year. And we expect that will be supported by both the economic stimulus measures and also the easing of lockdown measures, which have helped to bring about an improvement in the secondary market conditions for Sukuk instruments. At the same time, monetary stimulus measures that have been implemented by central banks across the GCC should help to free up liquidity across the banking system.
All right, Thaddeus Best, Moody's analyst, thanks for speaking with us on the program. All right, balloting exercise for 4 out of the 5 modern markets is being constructed by Kenya's government within Nairobi County, which has begun, and the stalls by small-scale traders, which are now complete, are expected to be occupied before the end of the year. According to the Nairobi County Commissioner, the 1.4 billion shillings project is aimed at addressing the plight of small-scale traders and will continue to empower and provide them with a conducive working environment for business. The County Commissioner urged those who will get stalls in the markets to observe Ministry of Health containment measures during this time of the COVID-19 pandemic. And that's our program today. Thank you for watching. I am BC Adebayo.